manager at Edge, a Cat3 AIF equity fund from Nuvama Asset Management, is with us on the show now. Ajay, afternoon. Before we get to the view, just quickly tell us, what is a Cat3 AIF equity fund? What is the mandate? And therefore, how are you approaching it?
Sure. So, good afternoon and thanks for having me. So firstly, category 3 AIF funds. So there are three types of, categories within AIF, which is alternative investment funds. Within that, the category 3 is mainly, where you have access to derivatives. And broadly, the minimum ticket size over here for the investor would be would be 1 crore. So here you can, basically have a strategy in place whereby if you have a bullish or bearish view in the market, accordingly, you can have your exposures and your strategy based on that, so as to ensure that you have some sort of limited drawdown on the portfolio when the markets are in the corrective mode.
Okay, now tell us, what is the market view? Near term, because you can play the derivatives market, so you can take a position even for the shorter term. So tell us the near term outlook and then of course the medium term.
Sure. So my sense is that, over last 2 quarters, if you have seen that, we are not yet out of the woods in terms of the global perspective. And the way we see from here on is that, if the rates are going to stay higher for longer, it will definitely have its impact on growth, more so globally and to some extent in India as well. So we all have seen, how the narratives have changed over last 2 quarters. Firstly, there was a fear of aggressive rate hikes in the first quarter, and that's how we saw a 10% correction in market in the June quarter. And then market took a comfort saying that inflation is likely to cool off and rates have also peaked, and therefore we had this 20% rally. So from now till first half, so again next year would be a story of 2 halves. The first half, I think the narrative that will play out is slowing growth, and therefore valuation may also contract. But the moment we'll see, growth slow down, bottoming out, again, the expectation would be that the Fed would come out and, start easing rates. So it will not happen, in the first half, maybe in the second half. And that time, we can again see a decent rally globally. But at least from now till, next 2 quarters or we'll see growth slowing down meaningfully globally and to some extent in India.
Right. A couple of sectors which are in focus today, and both of them are on the way up. One of them is the IT space, the other one is the metals pack. Metals, of course, comes in after some spate of underperformance, hopes that China will open up well. Wanted your thoughts on this place. Has the up move begun in the metal space once again? And on IT, the question is, has it bottomed out?
So on the commodities, fortunately, we have been positioned tactically in commodities since last couple of weeks. And it was, as you rightly said, it was on back of China reopening. And, this entire trade will not play out across all commodities, because we feel that, wherever China is importing, those all commodities can see an uptick. But wherever China is exporting commodities to the world, those commodities can see a downtick. So accordingly, if you look at the entire iron ore inventory position in China and many other metals as well, that is where, we can see some sort of, upside on back of this whole reopening. And so that was, on the commodity side. On IT, we have stayed away from that sector for a while. And I think till we don't get clarity in terms of, how much deeper the slowdown would be in US, I think it would be prudent to stay underweight or avoid that sector for a while, because if you look at the numbers, the earnings have been cut by say around 10 to 12% or maybe 15% in some case. Stock prices have corrected by say 25-30%. But if the slowdown accelerates, there can be another round of earnings cut. So we would ideally stay away and keep monitoring it very closely. Next 2-3 quarters, we'll get complete clarity in terms of how the IT budgets have been shaping up from most of the customers, and that will give a lot of clarity.
Right. Sorry, Ajay, on metals, so you want to stay away, right? You said export because China, or is it about metals which China will end up exporting? Only
what I meant was that if you look at the ferrous side, we are positive because the inventory level there is pretty low, and that is where we had tactically positioned ourselves in the portfolio on the long side. On the long side.
What else? Give us a little bit more color, flavor of what you're doing, Ajay.
Prashant, if you look at it, if the view is that, IT companies growth is likely to, slow down. And then if you compare it with other defensive sectors, and mainly if you look at, the pharma space, you are looking at many mid-cap pharma companies, which will be growing at somewhere around 12 to 15%. And most of the mid-cap IT companies, growth will also, over next 2-3 quarters will come down to those levels. And then if you look at the relative valuation for those mid-cap pharma companies, they are looking pretty cheap. So my sense is that, there can be a decent upside in few mid-cap pharma names from here on if you have a, 1 year view, considering it's a defensive sector and, the worst of the pricing in US also, price erosion is behind us, then that can again be a very good play.
But the broad view is that in the first half of 2023, things go south from here, right? It's going to be top-down pressure. Markets correct?
Yeah, I think so.
But the second half recovery is also fraught with risk, right? The second half of the year recovery that you're penciling in is dependent on a pivot from the Fed.
Yeah, so broadly, the thing is when I say correction, you also have to take into account that, over last 2 years, if you look at FY22 and FY23 so far, FIs have sold close to $55 billion of secondary equity. And, the correction over here may not be that, sharp, but I would say that markets can remain sideways. I feel that, at 20 times FY24, because this year we'll end the Nifty earnings at somewhere close to 810. And next year we should be somewhere close to 920, 930. So basis that we are trading at close to 20 times. And that leaves limited room on the upside considering we are in a high interest rate regime. And therefore, the market may remain sideways over here. But second half, the moment, the global markets and the emerging markets start building a narrative that Fed has pivoted and, the cuts will start, that is when, we can again see a very decent rally. Because then if you are looking at FY25, you're eventually looking at, 1,050 rupees EPS for Nifty.
Well, you said that this year we can end with 10% sort of EPS gain, and the next year, based on your projections, could be around 13 to 15%. Could you give us a sense of what sectors would lead that EPS gain, and understandably, one should position themselves in those sectors itself?
So, Mangalam, we still continue to like the private sector banks. We feel that they are still very well positioned, considering, the strong credit growth and benign asset quality. Although one may say that, the valuations are, at the mean level. But if you look at the FI ownership in this sector, what it used to be earlier, if you compare it with the current, the holdings, it has come off pretty sharply. So my sense is that as and when India starts getting fresh allocation within emerging market, private banks will attract a lot of money. And that is where, we continue to maintain a positive view. Secondly, I feel that, the way private capex has picked up in the country, and if you look at the data, it is comparable to the 2003-2008 period. And the best part about this, cycle is that it is pretty much broad, right from, steel, cement, chemicals, pharma, and many sectors. We are seeing a significant capex announcement. So the entire infra cap goods space, I understand that the large caps have, are pretty expensive right now. But I feel that, there are still quite a few pockets of opportunities in that space which can do pretty well next year. And again, in terms of ownership, not many, investors have still positioned towards this sector. And mainly, this can happen before the, the central budget election in 24. It can be a good sector to, participate.
You like pharma, steel, private banks, and you're negative on IT and auto.
Yes, exactly.
Okay. And are you taking short positions in IT and auto, or is it just an avoid?
No, it's as of now, it's just an avoid. So we are managing our risk through the indices. As of now, we are not short in that space. But any, upside from here on in these two sectors can be used to basically, go short on that.
But if the call is that markets are going to just correct sideways, if not correct, at least move sideways, then should your portfolio not be positioned for, some short, on the way down instead of only having longs?
No, so as I said that, Rima, how does this work is basically you manage your exposure. So if you look at any pure, a conventional strategy, that would always have 100% exposure on the long side. Whereas we end up managing our exposure depending on the market risk environment. And that is pretty much low right now to protect any kind of downside. So that is how the strategy works.
All right, we'll leave it there. Thank you very much. Appreciate you joining in today on the program. Thanks very much. 130 points, which means that the index is, by the way, I think if we have the Nifty up.
All-time high. I mean, not all-time high, sorry, days high.
Eager, huh, Rima? Eager. Well, yeah, we are at the day's high. 18,147 is the day high. We are at 18,142, and which, by the way, basically takes us exactly at we are slightly about 10 points above the 18,130 level, which is the 38% retracement, and now we're bumping into that rising trend line all the way from the lows of June. Exactly there now. So this is interesting. This is turning out to be a pretty forceful day after yesterday's pretty strong bounce that we had. So let's see if we are able to take this out, close above it. That'll be something, and I think will only add to confidence that there perhaps is more to go. And yesterday was not a one-day wonder, as many were kind of pointing to earlier in the day. We'll take a break here. We are back. There's 9 minutes to go for market closing. More on the other side. Stay with us.